Well, good afternoon. Thanks for joining us. I guess for some of you out west, it might be good morning, but we're glad that you're here. I'm Michael Thompson. I am the Director of Education for TC2000, and with me today is Peter Warden, co-founder of our company. Peter, thanks for carving out the time to talk today.
Thank you, Michael. Hello, everyone, and welcome.
Hey, I just want to quickly tell you, we're going to be looking at one chart today. We have been, over the last couple of webinars, kind of bringing you in some tools to help with analyzing the broader market. But being with the nature of the market right now, Peter and I were talking, and it seemed like a really good time to visit the VIX, which some lovingly call the fear index, and spend a little time with that chart and hopefully help you to see how you can take a chart like this, put a comparison on it, and do some pretty interesting analysis. So we're going to basically spend time with one chart, and at the end of the session, I will show you how to set it up. It's very simple, and I'll do the mechanics with you right at the end to kind of, so if you want to set this up or use it with other symbols beside the VIX, you'll know how to do that. But I'm gonna actually hand this off to Peter, so your screen might flash here for a minute as we pick up his screen. Peter, it's coming your way.
Okay.
And I'll let you know when I can see. I got your screen. Looks great.
Okay. Good.
So
Good.
We're ready.
Yeah. As Michael was saying, in some of our previous webinars over the last month, we have been talking about kind of looking at what's been going on in the major market indexes, in the S&P 500 and in the NASDAQ, and doing some different things with moving averages, measuring the performance of the individual components of the S&P 500, and seeing maybe what that might uncover under the surface, instead of just looking at a chart of the index alone. And, obviously, in more recently, the VIX has been quite a big topic. Volatility has obviously been a big buzzword over the last month, because we have seen increased volatility in the market. We're seeing some pretty big swings. And in fact, the market today is, I think, the Dow's up some 400, 500 points. So volatility is something a lot of people are watching. And for those of you who don't know, there is very much a correlation. It's really an inverse correlation between the VIX and the market. And in this case, as our market proxy, we're using the S&P 500. So what you're looking at simply here is a chart. It's a daily chart, meaning that each plot is one day. And I have a chart of the VIX itself, and I've overlaid a line chart of the S&P 500. Both are being displayed as line charts. Now, of course, we could display them as bar charts or candles or whatever, but I kind of find for this type of comparison and keeping things as clean as possible, I like using the line charts. You get a bar chart up there of the VIX, and things, the volatility even seems to increase more, on a day-to-day basis. So a little bit cleaner to read. So what you're looking at, as I said, is just simply a comparison of the VIX and the S&P. The VIX is plotted in the sort of dark orange, brown, if you will, and the S&P 500 is plotted in sort of the cobalt blue. And what we want to do is, I think, maybe go back a little bit here to pre-pandemic, just prior to the whole start of the pandemic, and look at what happened there with the VIX and what happened with the market, and maybe just leading up to it even. And I'm not trying to say that the VIX is a predictor of market direction. I'm not trying to say that at all. But it is interesting to see the behavior of the VIX during some of these various periods where the market moved, up or down, and sometimes moved abruptly up or down.
Yeah.
And if you just come over to the left side, can everybody see my mouse? Well, I guess you can't answer me, but Michael, you can see made my mouse cursor a little bit bigger just to kind of help you sort of zoom in on what I'm talking about. And it is interesting that just prior, and of course, we're back here in early 2020, and the horrible time here when the whole COVID broke and the pandemic started, and we had that huge drop in the market that started from the February highs into the March lows. But it is interesting that the VIX actually was starting a pattern here of higher lows, and higher highs. And that was happening as the market was moving higher. We did get this little dip right here at the end of January, a little hiccup, but we did go to a subsequent new high for the market. And then, of course, we know what happened then. But it's interesting, too, that the VIX, again, already a pattern sort of shaping up here where a pattern of higher lows and higher highs preceding this move down. And then, of course, as the market rolls over, we get this very big spike up in the VIX. And that spike really begins to, it just comes out of the gate very, very quickly, very sharply. And it does that in the very early stages of that downturn. It's not until we get way up here in the VIX where we ultimately spike to the peak that we finally reach the ultimate market low down here in March, in the second half of March. From there, really, we know what happened. It's amazing that it did. I'm still astonished at how abruptly this market turned around. And from a V bottom, I'm not a huge subscriber to V bottoms, but the market always does, of course, what the majority expects it not to do, and that was a case there where that V bottom just vaulted that thing higher, and the VIX, of course, is coming down all along and making really lower lows and lower highs, but we are getting these little spikes, and as Michael mentioned earlier, the VIX is many times referred to affectionately as the fear index, and of course that's what this is. That's what, when you get a spike like that, that is fear. That's blood running through the streets, and that obviously is a correlation. When you do get that extreme fear, that does correlate many times to market bottoms and major market lows, as we saw that it did in March of 2020. But it is interesting, as the market does plug higher, you do get these little, periods of fear spikes. Again, where the market is moving higher, most people not really trusting it in those early months for sure, and you get the little spikes in the VIX when the market turns down or starts to turn down. Like, okay, that's it. And and I have to say that I think that when we got into that June, July period, I sort of thought, well, okay, we've recovered the majority, 2/3 of that huge drop that we saw in February and March, but that's probably going to be it, and we're going to have to go back down. We're maybe going to have to go back down and test the lows, but the market just kept plugging along, and with that, the VIX really started to relax a little bit, still getting nervous each time the market turned down. We're getting that, but all the time making kind of lower lows. So we still got these little, these periods here of fear, these periods here of where people thought these downturns. I mean, it's amazing. This is a very little downturn, more so back here. That could have been the beginning of the end of the rally, as many people expected it might be, here in June, here in September, and again in October. So it's understandable that you got these spikes, but it's interesting too that you came off those spikes and everything kind of moderated so quickly. Like, okay, well, everything's honky-dory again, and we can drop back down to levels that I feel reflects almost a complacency in the market. Now, that can be a bad word, complacency. That's when you get so many people just feeling so comfortable in the market that, sooner or later, maybe that thing is going to change direction. But it didn't happen. And here, it's interesting. This is a much more minor dip here, and of course that was the theme of the whole advance, was that the dip buyers, we couldn't get a 5% correction in the market, but we did still. There was enough people that had their finger on the button, the panic button, so to speak, where we did get these spikes. And to me, in retrospect, I kind of feel like those spikes, those fear spikes, that was part of why we were able to maintain that uptrend, and why those dips were so shallow, because the fear grew very quickly. We got those big spikes in the VIX into those dips, and of course, as I said, subsequently we moved to higher highs. But most recently, down in this period here, this year, since really April, May, we've really seen, a VIX trading very, very low in its range, and the market continuing higher, and again, everything looking very good in terms of no fear in the market. Again, I know it's a contradiction. It's a bit hypocritical. That's when you really have to watch out, when everything looks so great and the charts all look so great and the market keeps making new highs. But nonetheless, we did kind of calm down with the VIX. Now, that's starting to change perhaps again, because now we're starting to see, we don't have a higher high yet, but we do have this period of lower lows that's taken place over the last couple of months.
You mean higher lows?
I'm sorry.
Yeah.
Excuse me. Higher lows. Exactly. Yeah. I mean, higher lows. And yes, I know the market has rolled over a bit and has corrected. And yes, lo and behold, we have actually had a correction of 5%, or maybe slightly more than 5% in September. And but it's just interesting that now this is going to be an indicator that I think everyone needs to be watching. I need to be watching, because I'm interested to see if the VIX is going to take out this previous high. Now, this is on a daily chart. I'll go ahead and just zoom in a little bit here. It's on a daily chart, but it's also interesting to fool around with changing your time frames, even on your VIX, because remember, this stuff is all streaming real time. So you're not limited to looking just at a chart where you're looking at daily plots. And even the daily plot, that is the most current plot right there, that's happening in real time right now at 12:44 Eastern time. But fool around with some of these other time frames, and you find some interesting, perhaps a little more sensitive, same correlations, but maybe happening on a little more sensitive basis. And you can see here that, again, we get these spikes that take place, spikes in the VIX with lows in the market. Big spike there.
It's really interesting because the pattern is very similar as the daily chart, but on this one, that high in September, in mid-September, actually did take out the previous high in May. So on an intraday basis, that pattern that you were suggesting could possibly happen in the daily it literally did happen.
Yeah, you're right. That's a good point.
More exaggerated.
Yeah, they look, and right, and the spikes are more pronounced, obviously, because we are on a shorter term time frame. Yeah, I mean, as you zoom in a little bit, you see that we actually, this looks like this is the highest spike that we had just a couple of weeks ago on this particular chart in the VIX. And again, what happened? Well, we got a sold out low as a result of that. And I think we've even been talking a little bit about, in a previous webinar, we looked at that same low and we saw that the majority, I think in probably 90% or more of the individual stocks in the NASDAQ 100 had actually fallen below their 10-day price moving average. So again, an indication that, you know, we just got overdone on the downside. And we know what happens when we get these spikes in the VIX. We are either at or close to a low, a trading low anyway, as it were.
Yeah.
You know, we have since gone up, made a lower high. We have not bettered those record highs of beginning of September, end of August, and we've in fact gone to a lower low. So on a shorter term basis, you know, we are in a downtrend right now, and the VIX is in an uptrend. And we did get another spike here, which I think occurred, what was that, yesterday, the day before?
Yeah.
Yeah, I think that was yesterday, wasn't it? As we dropped, because the market was down like 500 or something at its lows yesterday, right? And we got that other spike, and then of course now we're getting more of that relaxed pullback in the VIX at this time, and we're getting the market rallying. So it'll be interesting to see if the market, you know, manages to hold these lows. Let's try to shorten things up a little bit more and see if anything else pops out. It's really the same kind of pattern. It's just, again, really, as we shorten our time frame, making it a little more sensitive. So obviously those spikes are going to occur a little bit quicker than they would on a daily chart.
What if we went the other way, Pete, and went up, say, to a 3-day or a weekly or something like that?
That's a good idea. Let's try it.
Oh, wow.
Yeah, and there we get, you know, looking at this is the 3-day. There you get a period, or you get a, if we were looking, like, for instance, if we were to take like a linear regression line and draw it from here down to here, we see much clearer a complete and orderly contradiction of trends. You know, we see the VIX really making, for the most part, lower highs throughout this whole advance and lower lows.
What about a weekly? Yeah, it's showing that same reversal where those bottoms are coming up. Really, it started in early July, right? Toward the beginning.
On the weekly, yeah, you know, you can see, right, that the VIX really did bottom out there at the beginning of July, and has really started to kind of round out a bottom here on the VIX. And, you know, there's, again, there is this correlation that exists, obviously, this inverse correlation between the VIX and the market. And, you know, and there's certain things that you can, you know, things happen. They don't always happen for one reason. In fact, they seldom happen only for one reason. There's lots of things that go into reasons why the market does what it does. And the VIX, you know, remember, this is a volatility index. This is a gauge of volatility in the market. And one of the things that traders, or especially probably bigger investors, use as a hedge is they like to buy volatility when they think volatility is cheap, because that's a great protection from, you know, in other words, they're able to protect their stock exposure or their equity exposure, because they know that if the market were to suddenly move down, that they're going to see volatility increase. So maybe they have some call options that they've purchased. And so, you know, what you could be seeing or have been seeing over the last couple of months is, I think certainly a contributor to this is, I think that volatility was cheap, and there were people that were buying volatility and probably still are buying volatility as a hedge.
So it kind of underlines a nervousness, even as we, from that July point up to beginning of September, I think that's about a 10 or 12% rise in the market. And yet the market going up, you can see that nervousness, people buying that protective volatility. I think there is that sense of fear that how long can this last, and when it turns over, how bad will it turn over, you know?
Yeah, a little bit, but, you know, again, we had on this chart this dip back here, and we get this spike, and we had this dip, and we get this spike, and we had this little dip right here, and we get this spike, and now we're pulling back. The pullback that we've seen in September, the magnitude of it is comparable to this, and it's certainly more than what we saw back here, but yet our VIX is really staying relatively low.
Yeah, that's interesting.
Yeah,
shows up really good on that weekly chart too, that you're not getting that severe reaction to this pullback. And like you said, some of those pullbacks that where you got the giant spikes were not nearly what we're looking at now, but we haven't gotten that big acceleration. That's interesting.
You can see too, again, to my point that I'm talking about, buying volatility when it's cheap. It's a cheap form of protection. You can see historically, it's not as cheap as it's ever been. It was cheaper back here in 2017, 2018, and even back here. But you can see you're very, very far down in that range. You're very close to those lows. So again, on a relative basis, the VIX really suggests that that volatility is at very inexpensive levels right now.
Yeah, while the market is at very expensive levels because it's so much higher now than it was.
Yeah, relative. That's exactly right. That's exactly right. So it'll be interesting to see what happens from here. And again, I think I would hope that everybody maybe puts VIX into one of their watch lists so they can check that on a regular basis.
Yeah, it's really an important chart. And by the way, for those of you that are watching, we have a lot of these kind of more breadth type either indexes or indicators. And as Peter pointed out, they all stream in real time. So you don't have to look at market breadth all the time in a long-term basis. We give you the tools that you can look at it even intraday as he's doing now. Well, you're down to a 3-minute chart.
Yeah, I'm on a 3-minute chart just to show obviously what, we know is obviously happening is that, we're getting a day here where the VIX is falling and the market's rising. And, but it is interesting again to look at those correlations. And we used to have a feature, and I don't think we have that feature anymore. And I really liked it a lot, where you could invert one of those overlays. Because I love to do that, because then you would, it's a little harder now for the eye to sort of see this and say, okay, what's the correlation? And if you could invert the VIX, all of a sudden, then the VIX is essentially going to be perhaps leading the market, if you know what I'm saying. Yeah.
Well, maybe you could talk to the owners of the company.
Yeah, exactly. Right, get that back in. I'm not even sure exactly why we ever took that out, but anyway, I don't want to harp on the negative. It's interesting. It's just, and again, Michael's going to show you how to set this chart up. It's so simple, and as I've said 100 times, if not more, I love to keep things simple. I love to keep my charts simple and clean. I don't like to just completely put a bunch of moving averages and a bunch of different things on there where I just get so lost and I just don't get that. It changes my chart interpretation, and that might be different for you. You might like to have all kinds of things on that chart, but for my chart interpretation, I like to keep things really clean and simple.
I agree, and I think in this case, this is a really good example, guys, of the different plot styles. This would not it would not be as easy to analyze if we had bar charts on there because it gets really noisy. And the line graph for this particular kind of study, I think, is way better because we're only connecting the closes at that point, and we're getting rid of a lot of noise.
Yeah, I'll just change it and show it to you. You just see it's just noisy. It's just so busy. It's like, and that's the daily. I did change it back to the daily, but in some ways a little harder to even interpret those spikes. But so again, it's really just a matter of adjusting the chart to the perspective that you want, and that makes it easiest for you.
Yeah, and you could certainly do that, but I do like these kinds of graphs, and any of the breadth indicators, any of the breadth indexes, like you, Peter, I always display them as a line graph just because I don't need to know all the stuff that happened during the day. I need to know where they closed, and those comparison points are a lot clearer. So I think
T2s, if I'm overlaying T2s, which I love to do as well, advanced decline lines and the and the different T2 indicators that we have in the software, I'm virtually always overlaying those, on basically looking at a line chart.
Yeah, and it's a practical point for those of you that are watching. That's one of the reasons we wanted to do this, not only to look at the market condition, but to remind you that there are a lot of tools available like the VIX. It happens to be an index, but we also have what Peter mentioned, the T2s, or the T2s are the breadth indicators, the broad market indicators, and there's a whole list of them in TC 2000. And again, I think they display way better when you see them in a line graph. And these comparisons, this is a great way to view it, because you're getting a direct kind of apples to apples comparison between the broader market, which you could use lots of different substitutes for. We use the S&P 500 here, but between the broader market and the indicators or the indexes that you're using, this is a great way to display it.
All right, well, that's really all I have for you today. So I guess we can turn it back over to Michael.
All right, I'm going to grab it back from you here, Pete. And just real quickly, guys, I want to show you how to create a chart like this. I've made mine look something like Pete's. And so I'm going to go in here and turn this off just so I can start from the beginning. So that's the VIX. That line that you see on my chart is the VIX. And it could be any of the market indicators. In fact, we actually have a list of those T2s that Peter mentioned. These are all market indexes. They can all be plotted the same way we're doing the VIX here. So pretty much any kind of a symbol like this, you can pull out, and we just happen to use the VIX. And then when you want to make a comparison to it, you could right click on your chart and go to Edit Chart Properties. And you'll notice there is a tab in this chart window, which this particular tool allows you to kind of edit anything that shows up on your chart. And it's got a list. You can do multiple ones of these comparison graphs. We're just using one, but you can have up to 10 showing on your chart, which is actually pretty cool. We have a few charts that we use like that. They're great comparison graphs. But you simply put a check mark by and enter the symbol that you want to see as a comparison graph. One really important thing to note is that out of the box, right down here at the bottom of this editing window, it will be checked like that, and it says start all plots at same point. Sometimes when you're using multiple plots, that's a great way to look at it, because it creates a percent change from the beginning to the end of the chart. And basically, it just throws all your plots on the same scale, and it gives you a real apples to apples comparison of performance. But in this case, we don't want to see that, because we want to see a hard overlay. So you just uncheck that. That gives you the picture that we've been looking at, and then click OK, and that's it. There is your VIX in the brown, your S&P 500 in the blue, and as you zoom in and out, as you change time frames, they'll both adjust to that. So it ties them together, and it gives you that on-screen look at the comparisons of these two plots. So it's something that you may want to use not only with the VIX, but with other market indicators and other market vehicles. We actually carry, I think it's 5 or 6 CBOE indexes that could be used like this.
Yeah, just on a side note, it reminds me too that, one of the things I used to do, I love MoneyStream. It's one of our proprietary technical indicators. I use MoneyStream a lot, and I virtually almost always display MoneyStream in a bottom pane, in its own separate pane underneath price on a chart. And I do that because I usually overlay a moving average on it. I look for crossovers and whatnot. But the great thing about MoneyStream, unlike something like time segmented volume, time segmented volume, you have to choose a parameter for. But MoneyStream is a cumulative indicator. It's like on balance volume. You don't have to choose a parameter for it. And so it works very well to overlay on price in the same window. Instead of dedicating a separate pane, you put MoneyStream right on top of price. And that's something I kind of got away from. And you sort of just jogged my memory on it, and I'm going to revisit that again.
Well, I'm actually going to do that real quickly because it's a great example of ways to use it. You see, I just added money stream as an indicator. I'm going to go to a stock symbol.
I used to do it when I did, when we traveled around and did training classes and seminars and whatnot, because I found that, the audience, there was many people that they could relate to it better. It just visually, it was more pleasing, and it was clear for them.
Right.
Because, hey, here's price making a higher high and money stream not making a higher high. You get your divergences and things are a little bit easier to spot.
All right, I'm going to turn off our comparison graph for now and just show you guys how to do this. You have an indicator plotted like money stream that will work as an overlay. Just click on the little move button, the little double arrow that's right next to the indicator, and choose overlay. And just that quickly, you have your money stream laid over it. And as you space bar through a watch list, let me grab one real quick. I don't have any open in this window. As you space bar through the watch list, you have your money stream laid over your price. And one of the fun things about this is it's really easy to see divergences when maybe the stock is going up and the indicator is going down, or vice versa, that kind of thing. So it is a very easy way to see that. And money stream is not the only one that you could display like that. There are a few that really do work well as an overlay. So you've seen here today that you can overlay an indicator, or you can overlay a symbol, which could be your comparison symbol. So there's a couple of little tidbit tools for you that'll help you get going, but hopefully you're going to take a look at the VIX and some of these other market indicators, but look at those T2s that were mentioned. These are great ways to get, step back, get a little bit more of a macro view, a little broader view of the market. All right, I think that's it. Pete, you got anything else?
No, I'm all finished. Thanks, Michael.
That was a great study. I hope you guys will take a look at that and throw it in your arsenal along with all your other tools. And we'll be back in touch soon. Pete and I are going to be doing as many of these as we can kind of fit in for you. So keep your eye on your emails. We'll be sending you emails and inviting you back. But thank you, Peter, for the study. And thank all of you for being here today.
Thanks for joining us.
We'll talk to you soon. Have a great day.
Good afternoon.